Hi guys. Sorry I'm a bit late because I finished the class late, the previous class late. So I'm going to just share the screen with you guys. If you can't see it, let me know, okay? I'm sharing now. Just give me a second. Okay, so this is the screen. If you can't see it, let me know. Otherwise, I'm going to assume that you guys can all see it, okay? All right, so welcome to tutorial 3. And in this tutorial, we are going to cover the lectures material that we introduced from last week, okay? So last week, we talked about the spot foreign exchange market, and we introduced two main points. The first one was we look at how banks record their international transactions between themselves through the corresponding banking relationship. In the second point, we talk about the terminologies in the spot market, and we look at some calculations, okay? So we look at some currency exchange. So in the spot market, we talk about direct and indirect quotation. So this refers to whether you price the foreign currency or you price the domestic currency, right? We also talk about the per USD and the in USD quotation. So per USD is when you price the USD in another currency, and in USD is when you price the other currency in the USD. Okay. We also introduce the dealers in the foreign exchange market, and the way they put up the prices is that they're going to put up a bid price and an ask price, okay, for each of the exchange rates. So with the bid rate is the rate that they want to buy the currency at, and with the ask rate is the rate that they want to sell the currency at, okay. So as a rule of thumb, when you have an over-the-counter market, when you have dealers in the market, they will be trading at their rate, okay. So when they put up a bid rate, they will be buying at the bid rate, and when they put up an ask rate, they'll be selling at the ask rate, okay. On the other hand, the customers will be the counterparty of their transaction, okay? So the customers therefore will be trading at the opposite rate to the dealer, okay? So for example, if a customer wants to buy a currency, they'll be buying at the ask rate of the dealer and vice versa, okay? So when they sell the currency, they'll be selling at the bid rate. So let's look at the correspondent banking example from last week. Now, last week in the lecture, we looked at an example where we have two banks, one from Italy and one from the UK. So the Italy bank wants to exchange the, excuse me. So the Italian bank wants to exchange the euro for the pound. And at the current exchange rate, 1 pound is equal to 1.1 euro, okay? So that 100 million pound is equivalent to 110 euro. So in this transaction, Bank X is going to exchange the euro. So they're going to pay the euro to Bank Y, and they're going to receive the pounds, okay? So they exchange the euro for the pounds. As a result, we would expect to see an increase in their pound holdings, yeah? So because they received the pounds, they should increase their pounds holding. At the same time, because they pay the euro to Bank Y, we should expect a decrease in their euro holdings, okay? So because this is an exchange and Bank A and Bank X and Bank Y are just exchanging an equivalent amount of pounds and euro, we should not see any change in their assets, okay? On the liability side, it should be the opposite. So because Bank X is paying Bank Y in the euro, their euro liability should increase. At the same time, because they receive the pounds, their pound liability should decrease, okay? Overall, their liabilities and equity should not change, okay? So if we do the same analysis for Bank Y, we will see that they have the opposite change. Okay, so because they're receiving the pound, they should see an increase in pound assets. They pay the they receive the euro, so they have an increase in the euro asset. They pay the pounds, so they should see a decrease in the pound assets. On the liability side, it should be the opposite. So overall, bank-wise assets and liability should not change as well. Okay. Did someone want to say something?
Oh yeah, I did, but I want to like. Do you just want us to interrupt? Like, I wasn't too sure.
Yeah, it's okay. Just
Yeah.
that's
I was just asking with this one, the 400 and the 770 million doesn't equal the total liabilities and equity, or are we assuming that there's more liabilities like listed above? Is that what we're assuming?
no, so you have to pay attention to the currency here. So you
Yeah.
can't just add up these numbers.
Yeah.
You've got to convert them into the pounds first.
Oh, okay. Yeah. Okay.
Yeah.
Yeah, because
So
I was adding it all up, like, and I was like, oh, okay.
yeah, no.
That's
Yeah.
equal total, given the exchange rate.
Yeah. So
Okay.
yeah, good question. So you can't just
Yeah,
add these
sorry.
numbers up. Yeah. So you have to convert them into a common currency first.
Okay, yeah, I get you. Cool.
Okay, thanks, Leah. So on the next slide, I have the direct and indirect quotes. So just notice that when you read the textbook assumed that the US is the home country, right? So as we mentioned before, these are two American authors. So the textbook is written from an American citizen's point of view, okay? So throughout the subject, I'm going to assume also that the USD is the home currency, just to be consistent with the textbook, okay? So if the US is the home currency, when I say direct quote, that means we are trying to price another currency in the USD, okay? For example, in this case, I'm looking at the euro. I'm trying to compute the exchange rate between the euro and the USD, okay? So when I talk about a direct quote for the euro from a point of view of a US citizen, then I'm talking about the price of the euro in the USD, okay? So as a result, if I look at this table here, this table tells me two things. Number one, in the in USD column, it tells me the value of the currency in the USD, okay? So this is how much a euro, for example, is worth in the USD. In the second column, I have the per USD value. So this column tells me the value of each USD in the foreign currency, okay? So going back to our example here, when I say a direct quote for the euro, I'm talking about the price of the euro in the USD, okay? So the direct quote here is therefore 1.1321 USD per euro. In terms of the indirect quote, this is the price of the home currency in the foreign currency, yeah? So as a US citizen, it will be the price of the USD in terms of the euro, okay? So in this case, it will be 0.8833 euro per USD, okay? One more important thing to notice is also that whenever you have an exchange of currencies, say if you want to exchange the USD for the euro, in a currency exchange, there will always be two simultaneous transactions, okay? So when you exchange the USD for the euro, you're giving the bank the USD, and in exchange, the bank gives you the euro, okay? So for you, you're gonna have to pay the USD, and at the same time, you're receiving the euro, okay? So therefore, when you say you're buying the euro, it's equivalent to saying you're selling the USD, okay? So this will be handy later on when we talk about the bid and ask prices, okay? Currency quotations. So we also talk about different types of terminologies, right? So if we talk about a spot exchange rate between currency J and K, this notation stands for the spot rate. So S is the spot rate as opposed to the forward rate, which we'll talk about in the lecture today. Now J over K is my exchange rate, yeah? So J here is the measurement currency and K is the commodity currency. So when I interpret S J over K, this is the price of currency K in currency J. Or in other words, how much one currency K is worth in J, okay? So as an example, now if I look at the spot rate between the Euro and the USD, so I'm looking at the Euro over the USD rate, okay? So in this case, the USD is my commodity, which means I'm trying to price the USD. And the Euro is my measurement currency. So this is the unit of pricing, okay? So this number here, 0.8657, tells me the value of each USD in terms of the euro, okay? So each USD is worth 0.86 something euro. Does that make sense? So this will come in handy later on when we look at the calculations in the tutorial, okay? So with the bid and ask prices, the notation will be the same, except that I'm going to introduce a superscript here, okay? So I have SJ over K as before. Now I'm going to introduce B, the superscript B for bid and superscript A for ask, okay? So how am I going to interpret this number? So SBJ over K tells me the rate that the bank is willing to buy currency K at in terms of J, okay? So this is the rate that the bank buys currency K in currency J, okay? And if I have the superscript ask, it's just the asking, it's just the selling rate for the bank, okay? We also talk about the conversion from direct to indirect. So if we take the reciprocal of one exchange rate, we will get the exchange rate for the other currency, right? So for example, if I take the reciprocal of this rate, the SBJ over K, I will get the ask price for K over J, okay? So the way I interpret this is that the price of currency K in J is simply just the reciprocal of the price of currency J in K, okay? And when I take the reciprocal of the ask rate, I'm gonna have the bid rate for the other currency. It's just because, say if I'm buying currency K, it will be equivalent to me selling currency J, okay? So for example, in the previous example, when we have this quote over here, so this is the price that the bank, so if the bank is buying 1 USD, they are willing to pay 0.8657 euro, right? So if I take the reciprocal of that rate, I will get the asking price for the euro over euro, for the USD over euro exchange rate, okay? Which means that this is the rate that the bank is selling the euro at in terms of the USD, okay? So that were the main points for the lecture from last week. Any questions so far? Or are we happy to move on to the tutorial? If we don't say anything, I'm going to assume that we're happy to move on to the tutorial.
Yep, I'm happy to move on.
Okay, thanks, Leah.
All good.
Okay, let's go to question 6, which is the first question in chapter 5. So the question here is, why does most interbank currency trading worldwide involve the USD? Okay.
USD is the reserve currency of the world.
Exactly, right, spot on. So the USD is one of the most popular currency in the world.
It's the strongest currency, isn't it, compared to AU?
Sorry, can you say that again? I can't hear you very well.
It's the strongest currency, isn't it, compared to the AU? The strongest currency is the euros, the AU, the US.
Yeah. So in terms of absolute value, it's not the highest value currency, but it's a very strong currency in the sense that investors have great confidence in the currency. Yeah. So the strain of the USD is quite strong relative to other currency.
Okay.
So it's spot on. So the reason why the USD is used as the common currency for denomination is because it's quite strong. And therefore investors feel comfortable to transact in the USD, right?
Miss, how would you compare USD versus the Chinese yuan or the Japanese yen?
In terms of the value or
The value, yeah.
yeah. So
You get the three because economies there, yeah.
So in terms of economy, the Chinese economy is currently the second largest economy.
Mm-hmm.
But in terms of their currency, because they have been keeping their currency quite weak, so I would say that the USD is relatively higher in value to the yuan.
The USD is more in demand, yeah.
Yeah, it is more in demand. Yes.
Okay. Okay. Yeah. Cool.
Yeah. So the USD is higher in demand, and also investors have confidence in the USD. And as a result, we just use it as a common currency for international trade. So besides, yeah, did you want to say something?
No, keep going. Okay.
So besides the USD, the other common currencies are the euro and the Japanese yen. So the reason is for the Japanese yen, of course, these two currencies are also strong. With the Japanese yen, because they have been trading a lot with Asian countries. So for Asian countries, it makes sense that they use the Japanese yen as their denomination as well. Okay?
Yeah.
So these are the reasons why these three currencies have been quite popular. Okay, so let's move on to question 8. So I think this is an interesting question in the sense that you need to think about a bank's trading strategy, right? When they put up a bid and ask prices. So in this question, we have, hang on, why did I?
Okay. Is this chapter is from the textbook, yeah?
This is from the textbook, yes.
Which is economics and development, correct?
No, this is international financial management.
Yeah, sorry, I've got too many textbooks. International financial management, yeah?
Yes, correct.
Bruce Resnick, yeah?
Yes, correct.
8th edition, yeah. Yeah, cool.
So
We're gonna read this for the assignment, yeah?
Sorry, can you say that again?
We have to read this for the assignment, correct?
You will need the textbook for the assignment, yes.
That's due in 15 days.
I'm sorry, what was that? So your textbook will arrive in 15 days?
No, just carry on. Carry on.
Yeah. I'm sorry, it's a bit noisy in the background, so I can't hear you very well.
It's not noise at all. Carry on, all good.
Okay, cool. Okay, so the question is, we are given a pair of exchange, right? So this is the dollar and the Canadian dollar and the US dollars. And the bank is currently quoting a small figure bid ask of 35.40. So this is our bank in question, yeah? So our bank gives a small figure of 35.40. And the rest of the market is trading at 36.41. Okay. So when we say small figure, we're talking about the last 2 digits of the currency exchange rate. When we say big figure, it will be the first 2 digits. Okay. So normally for banks, the first 2 digits will stay the same, and the small figures would change. Okay. So the rest of the market, let's say market here, the trading, the prices are currently at 36 to 41. So the question here is, what is implied about the trader's belief by his prices? Yeah. So in other words, if we look at Bank One's bid and ask prices, what does it tell us about their belief of the 2 currencies in question? Okay. So for this question, I want you to think about whether the bank is trying to whether the bank is trying to sell the USD or are they trying to buy the USD, okay? So our bank in question, are they trying to buy or are they trying to sell the USD, okay? So let's think about this for a minute, and when we come back, let's discuss the question, okay?
Isn't that the ask price 1.3441?
Yes, correct.
They're trying to sell it, yeah?
Which one, Bank One or the rest of the market?
So Bank One. We're on question 8, yeah?
Yep, we're in the question 8.
Yeah, so 1.3441 is a selling price, right?
So that is the rest of the market, yeah?
Yeah. Thank you for breakfast, sweetheart.
Hi, Van.
Yes.
Is it purchasing?
So is the bank trying to buy? Why do
Yep.
you think so?
Because they're purchasing for one less than the market and they're selling for one less.
So they are purchasing at here.
Yep.
Now, if you think about a client, so if they are purchasing, that means the counterparty will be selling, right?
Yep.
So if I'm a client and I want to sell, would I want to sell to Bank One or would I want to sell to the rest of the market?
Sell to the market.
Exactly, right. So in this case, they are not trying to attract, they're not trying to sell, to buy the USD, sorry.
Okay.
So because they put the price a little bit lower than the market, they are not attracting sellers, okay? So they're not trying to buy.
They're trying to get rid of stock.
Exactly, right. So they're trying to get rid of the USD.
Okay.
So the reason why we know that is when we look at the right-hand side. So when we look at their selling rate, they are selling at a lower rate in the market, yeah? So they attract buyers of the USD here. Does that make sense to everyone?
Yep.
Okay, thanks, Leah. So for our bank in question, on the bid side, they have a very low rate relative to the market. So they are not competitive on the bid side, yeah? So they're not trying to buy. So no buying. But on the right-hand side, they are more competitive because they are selling at a lower rate, okay? So they are trying to sell the USD. Okay. So if that's the case, what do we say about their expectation for the USD?
They will increase the demand for it?
No idea.
No?
So we're just thinking about the bank's strategy, right? So they are trying to sell the USD and they are not buying the USD.
They think it's overpriced at the moment.
Joey, yeah, they think the USD is overpriced at the moment. Yes, spot on. So when I'm trying to sell something, I'm trying to get rid of the stock. Yeah, that's because I think the market price currently is too high. Okay. So here they think the USD is going to depreciate against the Canadian dollar, and that's why it's better for them to sell today. Okay. So by looking at the bank's prices, we can deduce the expectation about the future. Okay. So in this case, the bank is thinking that the USD is depreciating. Okay. Question 10. So for this question, over the past 5 years, the exchange rate between the pound and the USD has changed from about 1.9 to 1.45. Okay. So the question here is, would you agree that over this 5-year period, British goods have become cheaper for buyers in the United States? Okay. So we have two countries, we have the UK and we have the US. And this is what it looks like. From 2015 to 2020, the exchange rate has changed from 1.9 to 1.45. Now, can someone tell me what this exchange rate tells me? How do I read this 1.9 number?
So 1.9 pound was $1, yeah?
No, it's the
The
opposite.
other way around.
Yeah,
Well,
it's the other
It
way.
will cost them $1.90 for £1 or for £1.
Exactly right, spot on. So the pound here is your commodity. So I'm trying to price the pound, and this is my measurement currency. Okay, so this number tells me that 1 pound is equal to 1.9 USD. Okay. Similar here. So this is 1 pound is equal to 1.45. Okay. Now, can someone tell me if the pound has depreciated or appreciated over the last 5 years?
Appreciated.
Depreciated, right? Spot on. So it is depreciated.
It's dropped in value, yeah?
Yeah, it drops in value, yes.
So they make it cheaper for British goods, right?
Exactly right, spot on. So when your currency is cheaper, it's easier for foreigners to buy your goods and services.
So in regard, it's relatively the same with the Australian market. Our dollars dropped probably around 60 cents. So that means our commodities are cheaper, or what we export.
Yeah, so in the current situation, yes, we have seen a drop in our currency value, unfortunately. So our goods and services will become cheaper.
Would
And
that attract more foreign investments?
Yep.
And fuel industries.
Yeah, so it will. Yeah, Leah, do you want to
I
say
was going to say
something?
it increases the demand for the dollar, doesn't it? Or
That
for that particular currency.
So when the price is cheaper, it increases the demand for the currency. Is that what you're saying?
Yeah.
Yeah. Because it's cheaper for people to invest in your country. Yeah.
And then that causes it to appreciate.
Yeah.
Eventually. Yeah.
Good, guys. Okay, can we move on?
Yeah, move on.
Okay, so we've got two problems left, problem 1 and problem 8. So in these problems, we are exercising, we're practicing how to calculate the cross rates, okay? So in problem 1, we have a table from exhibit 5.4 in the textbook. And what we need to do is we need to calculate the cross rates for 4 currencies based on the figures we have from this table, okay? So the 4 currencies in question are the euro, the Swiss franc, the Japanese yen, and the pound. Okay. Now, this table is what we saw at the start of the class. This table tells me the American quotes for different currencies. Okay. So on the left-hand side, on the left column, I've got the in USD values. So these are the values of the foreign currency in the USD. Okay. On the right-hand side, I have the per USD. So this is the value of each USD in terms of the foreign currency. Okay.
Yep.
So what we need to do is we need to construct a matrix similar to exhibit 5.6. So this exhibit is not relevant for our calculation, but for reference, this is what we need to construct. Okay. So I'm just going to show you the final calculation so that you can see what this matrix looks like. So for our question, we have 4 currencies. We have the Japanese yen, the Swiss franc, the pound, and the euro. So our matrix is a 4x4 matrix. Okay. So what I have here is I've got the cross rates for the relevant currencies. So for example, if I take the first cell, which is here, so it will be the row divided by the column, right? So this will be the Swiss franc over the Japanese yen. Okay, so this is the cross rate between the Swiss franc and the Japanese yen. Now, if I look at this cell over here, so it will be row divided by column again. It will be the Japanese yen over the Swiss franc. Okay. I think it's the opposite way. I'm sorry. Should be the opposite way. So this will be the Japanese yen over the Swiss franc. And this one will be the Swiss franc over the Japanese yen. Okay. So we'll come to that, but for now, let's go through one calculation as reference. Okay, so the 4 currencies we have, just to recap, are the Japanese yen, the pound, the Swiss franc,
The euro.
and finally the euro.
US. Yeah, euro, yeah. Euro.
Okay. So for each of the currencies, we only have one single quote. That means we don't have the bid and ask prices in the previous table, right? Which means that the calculation here is very simple. We're just going to apply the simple cross rate formula to work out the cross rates. Now, since the common currency is the USD, I'm just going to write my formula like this. So I've got the cross rate on the left-hand side. This is J over K. So this is my currency J over currency K. On the right-hand side, I have J over USD. And then I have the USD over K. Okay. So if I cancel these two out, effectively I'm left with J over K. Okay. So how do I read these exchange rates? Just to recap. Now J over K is the number of J for each K, meaning K is my commodity and J is the measurement. Okay. J over USD is the number of J for each USD. So in your table before, you will look at the per USD column. Okay. For the last exchange rate, this will be the number of USD for each K. So this is the in USD column in your table 5.4. Okay. So as an alternative, we can also write our equation as SJ divided by USD divided by SK divided by USD, right? But for this question, this is not quite relevant. It will become relevant for the next question, okay? So for now, we can just ignore the alternative. So let's apply this formula to work out, say, one cross rate. So let's say if we want to work out the Japanese yen over the euro cross rate, okay? So if I want to write the formula for the cross rate for this exchange rate, what do I write? I'm going to have the Japanese yen divided by the USD, okay? And I'm going to times it by USD divided by the euro. Okay. So one way to check if you get the formula right is if the Japanese is on the top. So if it's a numerator, it should be on the top here. If the euro is on the bottom, it should be on the bottom here. Okay. Okay, so as we mentioned before, in the first exchange rate, this is the value of 1 USD in terms of the Japanese yen. So I'm looking at the per USD column in my table, okay? In the second exchange rate, I'm looking at the in USD column because for this exchange rate, this is the value of the euro in the USD, okay? So if I'm going back to my table from before, table 5.6. So for this exchange, for this cross rate, I'm gonna need the per USD value for the Japanese yen. So this is my Japanese yen spot rate. I'm looking at the per USD column. So it will be this number here. For the euro, I'm looking at the in USD value for the euro. So I'm looking at the euro spot rate here, and the in USD value is just here. Okay. So for this cross rate, what I'm going to do is therefore I'm going to times these two numbers together. I'm going to times 109.03 with 1.1321. Okay. So let's do that. I'm going to erase it here to make it easier to see. So if I times these two numbers, I will get 123.4329. Okay. Are we good here? So how do I read this number? What does this number tell me?
Is the yen over the euro?
Yes, exactly. And how do you interpret that number?
So it will cost you 123.432 yens to buy 1 euro.
Spot on, Leah. So this is exactly right, right? So 1 euro is equivalent to 123 point something Japanese yen. Okay. So that's very important to get. So when you have the currency on the denominator, it will be the commodity currency. Yeah. So here, the value of 1 euro is equal to 123 something Japanese yen. Okay. Now going through the first exercise together, can we now do the second cross rate by ourselves for 1 minute? And when we come back, can you tell me the answer? Okay. So here I have the Japanese yen over the pound. And let me just walk through the formula. So if I'm going to calculate this cross rate, can you tell me what is my final answer? Okay. So 1 minute, guys. And when we come back, we will talk about it. Okay, are we ready? Can you tell me the answer?
I don't know if I was looking at the table right, but I got a like 135, but I don't think that's right.
No, I'm sorry.
Yeah.
it's not.
I don't think it was, yeah, I was,
Yeah, let's go back to the table and I'll walk you through.
yeah.
So the first term is exactly the same as the first calculation we did, right? So we just gonna replace this with 109.03, okay? With the second term, it will be the in USD value for the pounds. So if I'm going back to my table, so this is my table, and I'm looking at the in USD value for the pounds, yeah? So I'm looking at the first row here. Now in this table, by the way, when you see the forward rates here, it will be for the forward contracts, yeah? So for the spot market, we look at the first row.
Oh, yeah.
Yeah. So with the USD, with the in USD value for the pounds, it will be 1.4402, okay? So let me go back. So in this exercise, now my first term is Japanese over USD, and that will be just 109.03. My second term is the in USD value for the pounds, and that will be 1.4402. Okay. So if I times these two numbers, I will get 157.025. Okay. Are we okay? Are we clear about this?
Yeah, kind of.
The 1.4402, I
Yes.
thought it was the 1.4655.
Let me go back 1 second.
I think I might just be reading the yeah. So
Where did you get the 1.46?
sorry. I think it's just like the table that I'm looking at is just has different numbers to yours.
Okay. You must be using a different edition of the textbook.
Yeah. But
Okay.
I picked it from the same area, so I'm going to assume it's going to be right.
Yeah. As long as it's the same intersection. I've got a chat section here. I'm just gonna check. Yes, changing. Thank you. Okay. So if we do the same thing for the pounds and the Swiss franc, if I write this equation here, I'm not going to go through this exercise, but I'm just writing the equation for you guys, so you can check at home. Okay, so if I'm going to calculate the cross rate between the pounds and the franc, it will just be this formula. Okay, so if I go to the table, I'm looking at the per USD value for the pounds. And here I'm looking at the in USD value for the Swiss franc. Okay. So assuming that we do all the calculations in the previous steps, we will be able to construct this table. Okay. So I'm just looking at the second half, the lower half of the matrix. So if we apply the same exercise as before for these numbers, we'll work out these numbers easily. Now I want to talk a little bit about the first, the bottom half and the top half of the matrix. Okay. So as you can see here, for example, with the two cells here. Now the first one is the Japanese yen over the Swiss franc exchange rate. And the second one is the Swiss franc over the Japanese yen exchange rate, right? So as you can see, one is the reciprocal of the other. So that means if I have computed this rate, I can simply just take 1 divided by this rate, and I will get this rate, okay? So that could be a shortcut if you want to complete the table. Similarly for the pounds and the Japanese yen, so this number here will be the reciprocal of this number, okay? so on and so forth. Yeah, so for the euro, it will be the reciprocal of this number. And for the other pairs as well. Okay, so that's how these numbers are related in the cross rate matrix.
Is that because the direct ask is the reciprocal of the indirect bid?
In this question, we don't have the bid and ask, right? But it's just simply the maths, I guess. So if you take, say, this is the exchange rate for this cell, it will be equivalent to 1 divided by this exchange rate, yeah?
Yeah.
Yeah, so it's just the maths. So if you take 1, you divide it by 0.009, you will get this number here.
Yep, easy.
Okay, so let me move on to the next question, which is question A. So in question A, it's similar to the previous exercise. The only difference here is we introduce the bid and ask prices, yeah? So we make it a bit more complex. So in this question, we have 3 currencies. We've got the Swiss franc, we've got the USD, and we got the Australian dollars, okay? So for each of these 2 exchange rates, they are the exchange rate relative to the USD, okay? We've got the bid price on the left and we've got the ask price on the right, okay? Now, an Australian firm asked the bank for any Australian dollar over Swiss franc quote. So as you can see, this is a cross rate between these 2 exchange rates. And because we have the bid and ask prices, we need to compute 2 prices for this exchange rate, yeah? So we need to compute a bid rate and we need to compute an ask rate. So before we go to do the calculation, now in this exchange rate, is the Swiss franc the commodity or is it a measurement currency? So am I trying to price the Swiss franc here or am I trying to price the Australian dollars?
Yeah.
You're pricing the Swiss franc, aren't you?
Exactly, right? So I'm trying to price the Swiss franc. So this is my commodity. So the measurement currency is the Australian dollars, okay? So when I say bid or ask, I'm talking about buying and selling the franc here in this exchange rate. So in this problem, because we have the bid and ask rates, we need to be a bit more careful. Now, with the formula, it will be exactly the same as before. The only difference here is I'm introducing the superscript B for bid, okay? So starting from what we had before, I'm having this cross rate here on the left. On the right-hand side, I've got J over N, with N being the common currency, normally the USD, and then times N divided by K. This is what we looked at before in problem 1. The only difference here is I'm gonna write the B for bid as the superscript, okay? So one way to understand this equation is we can say buying the currency K in J is equivalent to buying currency N first, and then we use the N to buy currency K, okay? So in this example, if I replace the correct currencies in their places in the equation, I will get this, okay? So from here to here. Now my J here is Australian dollars, my K is the Swiss franc, and the N, which is the common currency, is the USD, okay? So if I want to work out this number, I will need to reference back to the tables I have from the start, okay? So let's look at the first term, which is SB Australian divided by US, okay? So if I look at my table, I can see that I've got a direct quote from here, okay? So in my table, I have the Australian divided by USD, okay? So this number is the bit rate for the Australian divided by the USD. So I'm just taking this number here, okay? So if I'm writing my equations, the first term will be 1.7725. Now with the second term, it's a bit more complex because I don't have the USD divided by the Swiss franc exchange rate in the question. What I have is I have the reciprocal of that, okay? So I have the Swiss franc divided by the USD. As a result, what do I want to do? I will need to take the reciprocal, okay? Because I want to convert from the USD divided by Swiss franc to the Swiss franc divided by USD, okay? So when I take the reciprocal of the bit rate for USD divided by Swiss franc, I will get the ask rate for the Swiss franc divided by USD, okay? So here I'm taking the reciprocal of the bit. I will get the ask for the other exchange rate, okay? So after I take the reciprocal, I will get SA Swiss franc divided by the USD. So if I look back in my table, it will be the rate on the right hand side, okay? So that means I can write my equation as 1 divided by 1.5970, okay? So my bit rate for the Australian divided by Swiss franc cross rate is given by this product here, okay? I'm going to just erase everything to make it less messy. So if I put these numbers in the calculation, in the calculator, I'll get a number of 1.0786. So can someone tell me what this number means? So my bit AUD divided by SFR is 1.0786. Someone tell me how to read this number?
It will cost 1.076 or 86 Australian dollars to purchase 1 Swiss franc.
Exactly right. So it will cost the bank 1.0786 Australian dollars to buy 1 Swiss franc. Okay. So this is a buy-in transaction for the bank. Okay. So for the ask rate, I'm going to do exactly the same thing. I'm just going to change the superscript from B to A for the ask. Okay. So I'm going to start with the same general equation as before. And then I'm going to replace the correct currencies in their places. So J over K is Australian dollar over Swiss franc. N is the common currency, being the USD. So once again, I'm going to look at the table to see what I have. Now, similar to before, I've got the first exchange rate, which is the ask rate of the Australian USD exchange rate. So I'm looking at the right-hand side number. For the second bit, I don't have it directly, but I have the reciprocal, okay? So I'm gonna just take the reciprocal rate. So in this case, what I'm looking at here is I'm looking at the bit rate for the Swiss franc over USD, which is this number on the left-hand side. So if I rewrite the equation, if I replace the correct numbers in the equation, it will be 1.7235 times 1 divided by 1.5960. Okay. So if I do the calculation, I will get 1.0799. Okay. So similar to what Leah said before, the way I interpret this number is this is the rate that the bank is selling the Swiss franc at. So to sell 1 Swiss franc, they require 1.0799 Australian dollars. Okay. So one way to check if you have like an exam question that asks you to calculate a cross bid and ask rate, one way to check whether you do it correct or not is to check if the bid rate is smaller than the ask rate. Okay. So from a bank's point of view, they normally would have a lower bid rate and a higher ask rate. Okay. So yeah, so this is the last question for our tutorial. Any questions so far?
If I have any questions, I'll email you, yeah?
Yes, or you can talk to me on Friday during my consultation time.
Can you email me the consultation times?
It's on LMS.
Yeah, it's on the LMS and the Zoom.
I'll have a look.
Okay. All right, thanks guys. If there's no more question, I'm gonna conclude the tutorial because I have another class at 12.
Yeah, cool.
Okay. Thank you so much.
All right, thanks, Miss.
Bye guys. Bye Andrew.
Bye.
Thanks Louise.